Assalamualaikum warahmatullahi wabarakatuh dan salam sejahtera kepada semua pelajar-pelajar yang dikasihi sekalian. Okey, hari ini kita berada live streaming di channel Cikgu Yati untuk topik 9 iaitu Absorption Costing dan Marginal Costing, dan kita adalah kelas ganti ya. Jadi diharapkan semua dah pun bersedia, dah pun bangun. Kalau siapa dah bangun tu boleh bagi komen dekat chat tu menunjukkan korang dah bersedia. Lagi cepat komen lagi bagus. So far tak ada lagi. Okey, tengok kejap ya. Okey, good morning cikgu. Okey, morning. Maizah tu insyaallah. Waalaikumsalam. Okey, waalaikumsalam. Ni siapa berarti? Okey, ni Insyira, morning. Alisha, selamat pagi. Muaz, selamat pagi cikgu. Okey, selamat pagi. Zakir, selamat pagi. Aidin Sofia, selamat pagi. Selamat pagi, morning. Ini Ling. Morning cikgu. Okey, Nazura, Zulaika, good morning. Okey, good morning. Dan Aisyah Subah, good morning. Okey, setakat tu je lah kot. Okey, sebelum kita teruskan kelas ini, saya menjemput saudara Irfan untuk bacakan doa. Silakan.
Bismillahirrahmanirrahim. Alhamdulillahirabbil alamin. Wassalatu wassalamu ala asyrafil anbiya'i wal mursalin wa ala alihi wa sahbihi ajma'in. Allahumma aftah alaina hikmataka wa anshur alaina min hazaini rahmatika ya arhamar rahimin. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Amin ya rabbal alamin.
Okay, now kita nak masuk ya topik 9. Hopefully kamu bersedia untuk topik 9. Dan topik ini agak very long formula, so you must know how to calculate. Ya, ini. Okay. Okay, saya tengah cek PowerPoint sekejap. Okay, this is the topic. Nanti kejap saya nak buat slideshow. Share. Tengah mencari application window. Topik sini. Okay. Okay, Irfan, nampak tak?
Nampak? Ada.
Ada kan? So, okay, this topic.
Ada
kan? Alright. Now, this topic 9, absorption costing and marginal costing. Maksud bahasa Melayu ialah pengekosan serapan dan pengekosan marginal. Okay, this topic you have a lots of formula and you have to memorize the formula. Sekejap ya, saya nak off ni sekejap. Okay, you have to memorize the formula. Okay. Now, you must know the definition of absorption costing and marginal costing. So, absorption costing and marginal costing, dia punya definition, okay, you have to calculate, actually the first one you have to calculate the product cost per unit, but you must know the definition of absorption costing. Okay, you can see that all the manufacturing costs are absorbed. So that means are allocated when you want to calculate unit produced. So you must know the component of manufacturing cost, direct material, direct labor, manufacturing overhead. But manufacturing overhead consists of two costs, fixed manufacturing overhead and variable manufacturing overhead. So you can see it absorb or applied the fixed manufacturing cost as part of the product cost. So also referred as full costing. Kenapa maksudnya full costing? Because dalam tu ada all the component, direct material cost, direct labor cost, fixed manufacturing overhead and variable cost overhead ataupun variable overhead cost. Okay, they comply with general accepted accounting principle. So maknanya dia ada tiga komponen including fixed manufacturing overhead. Okay, for this topic under absorption costing and marginal costing, manufacturing overhead consists of two categories or two components: fixed manufacturing overhead and variable manufacturing overhead. So you must take into account, alert this one, dia ada two categories for manufacturing overhead. Okay, under marginal costing, fixed manufacturing costs are recognized as period costs. So they're not included in the product cost. So you must, the item or the component for you to calculate product cost is direct material, direct labor, and variable manufacturing overhead. So for fixed manufacturing overhead are not included under product cost. So you have to treat fixed manufacturing overhead under period cost. Okay, kejap. I want to ambil pointer. Okay, nampak ni. Period cost. So fixed manufacturing are considered as period cost. So we have to add in the period cost or nama lain ialah selling and admin expenses. Okay, this one for internal use by management. So this one for managers only, not for the external user. You still remember external user for banking, for banker, creditors, investors. So this one is not for the external user, only for internal user. Okay, the difference between absorption costing and marginal costing. So we must know how to calculate the product cost. Okay, before that, you must calculate absorption costing and marginal costing based on actual costing or normal costing. So when I said actual costing, we are using actual direct material, actual direct labor, and actual overhead. So you will get the total, the one we call total product cost in actual costing. But under normal costing, we are using actual direct material, actual direct labor, and applied overhead. So you can see the difference. Here we are using actual overhead, and this one we are using applied overhead. So we have applied normal costing for job order costing and process costing. So same for this topic, we are applying actual costing and normal costing. The different component is for actual overhead under actual costing, and we are using applied overhead under normal costing. Okay, this one, actual costing. Okay, under actual costing, there are a few steps when you are using actual costing. Number one, okay, you can see number one, you have to compute or calculate product cost per unit. Per unit, not product cost, but per unit. And another one, the step number two, we have to prepare the comprehensive income statement for absorption costing and marginal costing, so that we have to prepare two comprehensive income statement, and we have to reconcile net profit between absorption costing and marginal costing. Reconcile, that means we have to make an adjustment. The different net profit between absorption costing and marginal costing because of fixed overhead. That is the only reason. Okay, now the formula for absorption costing when you want to calculate product cost per unit. So we are using direct material cost per unit, direct labor, variable factory overhead, and fixed factory overhead. Okay, these components are using actual, this one for under actual costing, we are using actual data in order to calculate absorption costing under product cost per unit. So we are using actual costing. So all these components are using actual data. So this is the first step. You have to calculate product cost per unit under absorption costing and under marginal costing. Okay, this one for marginal costing, we have to calculate product cost per unit for only three components: direct material cost, direct labor cost per unit, variable. Okay, variable factory overhead or variable manufacturing overhead is the same meaning. That one is the same meaning. Okay, you got total product cost per unit. So this one, this formula exclude fixed manufacturing overhead or fixed factory overhead. They just consider only three components. Okay, the second step, we have to prepare the comprehensive income statement under absorption costing and under marginal costing. Okay, this is the format for absorption costing. We are following GAAP. So this is the common formula that you have learned from previous semester. Sales, you have to calculate. Okay, for this absorption costing or for this topic, you have to calculate every item in this statement. Sales, you have to calculate. Cost of goods sold, you have to calculate for each item, and also selling and admin expenses. So this is the formal formula that you have applied for semester 1. Okay, sale less cost of goods sold, you got gross profit less selling and admin expenses, then you get net profit. So you can see that the difference is under absorption costing compared with marginal costing is for this part cost of goods sold and selling and admin expenses. So you must know we are using absorption costing based on GAAP. This is the common statement of income for external user. Okay, now we look at under marginal costing. We must start with sales less variable cost. Okay, actually we have applied this formula for topic for cost volume analysis profit. We just consider for variable cost only. So there are two items under variable cost. Number one, variable cost of goods sold and variable selling and admin expenses. So these two items we have to add all together and we get the amount total variable cost. So after calculate total variable cost, sales less total variable cost, then you got contribution margin. So under this costing, we are not, we exclude fixed cost of goods sold or fixed manufacturing overhead under cost of goods sold. But we have to calculate fixed cost in the period cost. So this one, fixed cost, there are two items, fixed manufacturing overhead and fixed selling and admin expenses. For these two items are considered as fixed cost. So you will get total fixed cost. When you deduct the amount, then you get net profit. So sales less variable cost, you got contribution margin and less fixed cost, then we get net profit. So there is the difference between absorption costing and marginal costing for statement of income. So that one is the second step when you want to compare the absorption costing and marginal costing. So this one is marginal costing. We have to okay, this one variable cost is another name for marginal costing. So reconciliation, that means we have to make an adjustment. What is the meaning of reconciliation? Adjustment. Adjustment, it means that the difference between, okay, see, the difference between net profit under absorption costing and net profit under marginal costing, the difference incurred because of fixed manufacturing overhead. So we have to add fixed overhead in beginning inventory and deduct fixed overhead in ending inventory. So when you calculate for this item, then you will find out that net profit under absorption costing equals to net profit under marginal costing. So the difference incurred because of fixed overhead under absorption costing are inventory or are calculated as product cost per unit. Okay, now, or you can calculate starting with net profit under marginal costing plus fixed overhead in ending inventory and deduct fixed overhead in beginning inventory, then it will equals to net profit under absorption costing. So this is one way for you to check that actually net profit under marginal costing is equals to net profit under absorption costing. But this amount is different because of fixed manufacturing overhead. Now I give you one example for actual costing. We have to prepare the product cost per unit under absorption costing and also under marginal costing. Okay, this is the question. Okay, Sir Rogers Liam Berhad started its business in 2020 and estimated overhead costs and actual overhead costs are the same. So this sentence, it means that we are using actual costing where the estimated overhead cost equals to actual overhead cost. So that means there is no under applied or over applied because estimated overhead cost equals to actual overhead cost. So this is the data for Sir Rogers Nurian Berhad. Okay, from this question, you can find that beginning inventory unit given is 0, unit sold or sales in unit 10,000, but unit produced 12,000. So the first step, you must identify beginning inventory in unit, ending inventory in unit, sales in unit, and production in unit. So from this data, we find out that there is a missing figure. So the missing figure is ending inventory. What is the formula for ending inventory? Beginning inventory plus unit produced and less unit sold. So we find out that unit unit ending inventory is 12,000 less 10,000 or deduct 10,000, then we get ending inventory unit is 2,000. So this data is very important for you because we want to prepare the statement of income because we have to calculate every item in the statement of income. And given that selling price is 30 ringgit per unit, and this item is very important for you to calculate sales in the statement of income. Now, given in the question, this is the actual data. Direct material, direct labor, overhead, This item represent for actual data. 6 represent for direct material, direct labor 4, and variable overhead is 2. Because we have to calculate the product cost per unit, we have to refer this manufacturing cost. And this one, variable selling and administration cost per unit. So it is very easy for you because they have calculated this item in terms of cost per unit. Okay, this one, fixed manufacturing cost per year. And we have to prepare the statement of income per month, the end of the month for December 2020. So you have to calculate fixed manufacturing per month, 72,000 divided by 12. Then you got the fixed manufacturing cost per month. And fixed selling and admin, you have to calculate based on per month because given in the question is per year. Okay, you are required. Okay, it is very important you should know. First, you have to calculate product cost per unit under actual costing using absorption costing and marginal costing. Okay, this is the normal step. This is the first step. Number 2, you have to prepare comprehensive income statement for the month. Okay, this one is based on monthly ended 31st December 2020 using absorption costing and marginal costing. So we have to follow the statement of income based on absorption costing and marginal costing. And number 3, adjust the difference of net profit between the two methods. So the difference between net profit, absorption costing, and marginal costing because of the fixed manufacturing overhead. Now we look at the answer for absorption costing, how to calculate direct material. So this one represent for actual direct material, actual direct labor, and actual variable overhead. Fixed, actual fixed overhead per unit. So we have to calculate given in the question for total fixed overhead represent for 1 year. So you have to calculate divided by 12, then you got only 6,000 per month. Divided by unit produced given in the question, then the answer for fixed factory overhead is 50 cents. The total unit cost is RM 12.50 cents. Or in other words, product cost per unit is 12 ringgit and 50 cents under absorption costing. So you must remember that under absorption costing, there are 4 components: direct material, direct labor, variable overhead, and fixed factory overhead. Okay, in other words, for fixed factory overhead is fixed manufacturing overhead. Okay, now we look at the product cost per unit under marginal costing. So we just consider only three components. That one, actual direct material per unit, actual direct labor per unit, and actual variable factory overhead per unit. Then you get the total product cost per unit. Okay, product cost per unit or total unit cost is the same meaning, but I prefer to say product cost per unit. So this one represent for marginal costing. It just consider only 3 components, not including fixed factory overhead. So the second step, we have to prepare comprehensive income statement under absorption costing. Okay, for this statement, we have to calculate every item. So number 1, sales not given in the question. So we have to calculate. The formula is unit sales times selling price per unit. There you got the answer, 300,000. So you just remember that you have to calculate every item in the statement income or in the comprehensive income statement. Number two, this one, less cost of goods sold. We start with the beginning inventory given in the question 0. Then you have to add cost of goods manufactured. The formula is unit production or unit produced times product cost per unit. Just now we have calculated product cost per unit under absorption costing. So you have to calculate cost of goods manufactured. So this one you have a lot of formula for this statement. So unit produced multiplied by product cost per unit or unit product cost, then you got the total 150,000. Then that what we call cost of goods available for sale. And this is the amount less ending inventory. So we have another formula, ending inventory. The formula is unit ending inventory times product cost per unit. So 2,000, we have calculated the ending inventory just now. The difference between unit produced plus beginning inventory less sales in unit. So you get this amount, 2,000 multiplied by product cost per unit. We have calculated just now. So the answer is 25,000. So in this data, in this statement, you have to calculate separately. And this is the answer for cost of goods sold. And sales deduct cost of goods sold, then you get gross profit. And you have to deduct or less administrative expenses. So there are two categories for fixed administrative expenses. Number one, fixed selling and administrative expenses, 36,000. This amount represent for 1 year, so divided by 12, so 3,000. And another one, variable selling and administrative. So you have to calculate. What is the formula for this one? Unit sold or sales in unit multiplied by selling and administrative per unit. So the formula is variable selling and admin per unit times unit sold. So you have to calculate another formula. 10,000 units sold times RM 2.50 cent. This one represent variable selling and admin expenses per unit. And you got this total. So this total we call selling and admin expenses. So you get the answer net profit 147,000. So we are using absorption costing under actual costing. So it means that we are using actual direct material, direct labor, manufacturing overhead is based on the actual data. Now we look at the second one. We have to compare the statement of income under marginal costing and absorption costing. So under marginal costing, we have to calculate sales because not given in the question. The formula is unit sold times selling price per unit. And you get 300,000 less variable cost. Okay, this is the different formula compared to absorption costing. So beginning, we start from beginning. Beginning given in the question is 0 plus cost of goods manufactured. So this is another formula. The formula is units produced times cost product per unit under marginal costing. Just now, this is the first step. Just now we calculate product cost per unit. So the answer is 144,000. Then you got the answer, cost of goods available for sale. And you have to deduct or less ending inventory. And you have to calculate ending inventory. The formula is unit ending inventory times product cost per unit based on marginal costing. So make sure you take the correct figure, not absorption, but we take the correct figure from marginal costing that we have calculated product cost per unit. And you got the answer 24,000. So this one we call variable cost of goods sold. And we have to add another variable cost. That one we call variable selling and administrative expenses. So we have to add another variable selling and administrative expenses. So we have the formula. Actually, this one we have the formula. Just now I show you. Unit sold times selling variable selling and admin expenses cost per unit, or variable selling and admin expenses per unit times unit sold. This is the amount that you have to calculate, not given in the question. And you got its total. So the total variable cost consists of variable cost of goods sold plus variable selling and administrative expenses. So this one we call total variable cost. So it is different from absorption costing. Sales less total variable cost, then we get contribution margin. So contribution margin just consider variable cost only. And this contribution margin, we need this amount to deduct fixed cost. Okay, we continue from the previous statement just now. Contribution margin under, oh no, this one is not under absorption, yeah. Actually, this one under marginal costing. So this one error lah, yeah. Actually, this one is not absorption costing, yeah. This one is under marginal costing. Typing error, normal lah kan. Okay, so this one is under marginal costing. Now just continue. Okay, after that we have to deduct or less fixed cost. There are two types of fixed costs. Number one, fixed manufacturing overhead. So you have to divide into 12 months. 72,000 represent for 1 year. So you have to calculate for monthly for the month of December. And selling and administrative expenses, also you have to calculate based on monthly. No, not based on money. We have to calculate only for the month of December. Then you got this answer, 3,000. And this is the total fixed cost. So you must know the total fixed cost. There are two total fixed costs. One, fixed manufacturing overhead, and another one is fixed selling and administrative expenses. So this is the total fixed cost. So it is different from absorption costing. And get net profit. So you can see there is the different amount under absorption costing and marginal costing. This is because of fixed manufacturing overhead. And we have to make an adjustment or reconciliation to compare net profit under absorption costing is, okay, based on the statement just now, we have calculated that absorption costing, the net profit is 147,000. And we have to add fixed overhead in beginning inventory, that is 0. So the answer is 0. And we have to deduct fixed overhead in ending inventory. The formula is this one, fixed overhead per unit times unit in ending inventory. So this one represent ending inventory in units, and this one represent for fixed overhead per unit. So this is the item that will make net profit under absorption costing is different from net profit under marginal costing. So the different amount for these two costing because of fixed overhead in ending inventory and fixed overhead in beginning inventory. Because under absorption costing, we have to add fixed overhead under the production cost per unit. Okay, that one is the actual costing. Now we look at another costing, normal costing. We have applied normal costing for job order costing and process costing. Now we are using normal costing to apply under absorption costing and marginal costing. There are 4 steps. Number 1, still we have to compute product cost per unit, but under this product cost per unit, we are using POV, predetermined overhead. And number 2, we have to calculate or compute applied overhead. After compute applied overhead, then you will find out whether under applied or over applied. We have to compare applied overhead with actual overhead. And the third one, we have to prepare comprehensive income statement. And the last one, we have to make an adjustment for net profit under absorption costing and net profit under marginal costing. And bear in mind the different amount for net profit incurred because of fixed manufacturing overhead. Okay, this is the formula absorption costing, but using normal costing. So we know that normal costing, we are using applied overhead. When we use applied overhead, it means that we have to compare applied overhead with actual overhead. And if you get applied under applied overhead, we have to show under applied overhead under cost of goods sold, but we have to add this amount under applied because we want to make an adjustment where under applied must equals to actual overhead. But if you calculate and you find out that applied overhead is greater than actual overhead, so we have to deduct. That one we call over applied. We have to deduct this amount in order to get applied overhead equals to actual overhead. So it's very easy for you. Under applied, we have to add under cost of goods sold. If over applied, we have to deduct this amount in order to get applied overhead equals to actual overhead. Okay, this is the difference. If you compare the format under normal costing and actual costing, we have to record under applied and over applied for cost of goods sold. And after adjustment, we get this amount, and this amount we call adjusted cost of goods sold. So you must remember this one is for normal costing, only for absorption costing. Kenapa? Because marginal costing, we are using actual variable cost per unit. So marginal costing, we still use actual costing because The variable costs are actual data, are based on actual data. Okay, this is the difference. Compare with actual costing. Okay, now, and the rest formula is the same, where operational expenses include fixed selling and admin plus variable selling and admin. Then you got the total for operational expenses, and is the difference between cost profit and operational expenses. That one we call net profit. This one is the normal step. Only the different part is for under applied and over applied. Okay, you can compare actual costing with normal costing. If you are using normal costing, there are two costs. One for estimated cost and another one is actual cost for fixed overhead only. Okay, now you look at the example. Syarikat Semegah practice normal costing system to allocate fixed overhead costs. Okay, you just focus for fixed overhead costs. It means that fixed overhead costs consist of budgeted manufacturing overhead and actual manufacturing overhead. Then you have to compare applied overhead with actual overhead. Okay, the company's normal production is 24,000 units. Okay, this amount, 24,000, is normal production. Another name for normal production is budgeted production. So we are using the basis production units. Okay, you still remember there are 5 basis ataupun 5 activity basis. Either you want to use machine hours, direct labor cost, direct material cost and production unit ataupun unit production. So our activity basis is unit production. So this is the budgeted production. We have to calculate POR or predetermined overhead for fixed. Okay, given that this is estimated manufacturing overhead. Okay, this item, this amount, we need this amount because we want to calculate POR, predetermined overhead, because we are using normal costing. When we are using normal costing, that means we are using POR, predetermined overhead, and applied overhead. That means we have to calculate applied overhead. Okay, this is the actual data, operational data for 2020. So this is the actual data. Beginning inventory 2000, unit produced 20,000 unit sold. Okay, for these 3 items, there are the missing figure. So what is the missing figure? Okay, this one you can calculate for this item, and you will you have to calculate for ending inventory. So the formula is beginning inventory plus unit produced and less unit sold. Then you get the answer for ending. So you have to identify. Okay, I just put ending. Okay, susah pula tulis ni. Okay, hopefully you know this is the ending. Okay, ending. Okay, I just erase lah this one. Okay, I just write down E only. E to represent for ending. Okay. So this item, the units, you must identify 4 units. Number 1, unit beginning. Number 2, unit produced. Number 3, unit sold. And the missing figure is ending unit, ending ending inventory in unit. Okay, this one, direct material per unit. Okay, this one represent for actual direct material per unit, actual direct labor per unit, actual variable overhead, but it gives you in total, so you have to calculate variable overhead per unit. Okay, nanti kita tunjuk the working. And this one, fixed overhead. Okay, this amount represent for actual fixed overhead. So we have to compare actual fixed overhead with applied overhead. Okay, this one is selling price per unit. Okay, all these item, we need this item because we want to calculate sales. Variable selling and admin expenses per unit. Okay, this is the variable selling and admin. We have to calculate variable selling admin expenses. Okay, in the statement. And this one, fixed selling and administrative expenses for 1 year. So we are preparing for yearly statement income. So you are required to calculate product cost per unit, calculate under or over applied overhead. So you must remember that when you want to calculate over or under applied, we have to calculate applied overhead. Before we calculate applied overhead, we have to calculate POR. POR, that means predetermined overhead, under fixed overhead only. Okay, just remember only fixed overhead. And the next one, we have to prepare comprehensive income statement for the year ended 31st December 2020, absorption costing and marginal costing. And the last one, we have to prepare reconciliation or adjustment. Okay, now we have to compute product cost per unit. Okay, you can see the difference between actual costing and normal costing. Okay, this one given in the question, total for variable cost, variable manufacturing overhead, and we have to calculate variable manufacturing overhead per unit. So given in the question, actual variable overhead divided by actual production unit. So this is the answer. Okay, hopefully that you can follow me. You can see, because this one you must calculate product cost in terms of unit atau per unit. Okay, for fixed manufacturing overhead, we are using predetermined, predetermined fixed overhead rate or POR. The formula is estimated annual fixed overhead divided estimated production unit. We are using the activity basis based on production unit. Okay, given in the question, estimated fixed overhead is 240,000 divided by normal production. Okay, this one is normal production, or in other words is estimated production or budgeted production, and it is different with variable overhead, because of variable overhead we are using actual variable overhead, actual production unit. We just calculate for fixed manufacturing overhead only, because in the question it is given estimated fixed overhead and estimated production unit. So this is the answer. And total unit, or in other words, product cost per unit under absorption costing is 42 ringgit and 80 cent, and we are using predetermined overhead for fixed manufacturing overhead. So that means we have to calculate applied overhead, because we want to find out over or under applied. This one ya, nanti kita kira. Now we look at marginal costing. Now we calculate under absorption costing. Now marginal costing, we just consider three components: direct material, direct labor, variable overhead are using actual data. So the total is 32 ringgit and 80 cent. We just focus only three components. Okay, now we look at fixed manufacturing overhead because in the question given two data for fixed manufacturing overhead, it gives estimated and also actual manufacturing overhead. So we have to calculate applied overhead. So this one represent for predetermined overhead for fixed only times 20,000 unit. So this one is actual unit production. So the formula for applied is core times actual activity basis. So this one predetermined overhead for fixed manufacturing overhead times 20,000 unit. This is actual unit production. And when we compare, we find out that applied is greater than actual overhead. Applied overhead 200,000 and the actual manufacturing is 180,000. So applied overhead is bigger than actual. So we calculate, we find out over applied overhead. So over applied overhead is 20,000. We have to make an adjustment under journal entry and also statement of income. So when you want to make an adjustment under journal entry, debit manufacturing overhead 20,000, credit cost of goods sold. We have to record cost of goods sold in the credit side because over applied manufacturing overhead. We have to deduct over applied under cost of goods sold account. Okay, now this is the adjusted journal entry. Now we look at the statement income or statement of comprehensive income under absorption costing, and we are using normal costing. Okay, normal costing, that means we are calculating or computing fixed overhead based on applied. Okay, we have to calculate as usual, just not given in the question. You have to calculate unit sold times selling price. So 17,000 units sold times selling price is 100, and you got 1,700,000. Cost of goods sold. So you have to deduct cost of goods sold. We start with beginning inventory, 2,000 unit. So this one represent for unit in beginning inventory times product cost per unit under absorption costing. We calculate just now. So the formula, I repeat, unit beginning inventory ataupun beginning inventory in units times product cost per unit under absorption costing. So you got 85,600 plus cost of goods manufactured. You have to calculate individually. The formula is unit produced. Okay, this one is unit sold. This one is unit beginning inventory. And this one ialah units produced times product cost per unit. You got the answer, 856,000. So the total for cost of goods available for sale is 941,600. Okay, the ending inventory. Ending inventory. Irfan, are you with me? Oh, dah tak ada. Okay, under ending inventory, if I tak ada, okay. Okay, now under ending inventory, you have to calculate. The formula is ending inventory in units times product cost per unit. So cost of goods sold, we have to calculate based on product cost per unit. For beginning, cost of goods manufactured, product cost per unit, and ending inventory, you must calculate based on product cost per unit. And this one, beginning units, beginning inventory in units, this one unit produce, and for this one unit in ending inventory. So the total is 214,000. And okay, the formula you should know, we have to calculate ending inventory, beginning inventory plus unit produced less unit sold. So you got ending inventory units. This is cost of goods sold. And you must know we are applying normal costing. So we have calculated just now and we have to deduct or we have to less over applied manufacturing overhead 20,000. We have to deduct this amount because we want to ensure that actual overhead must equals to applied overhead. So we have to deduct over applied overhead 20,000. And this one we call adjustment cost of goods sold. Okay, that is the difference when you are using actual costing and normal costing. After that, sales less adjusted cost of goods sold, then you got gross profit. And the rest item, we have to use the same format. So from gross profit less operational expenses and under absorption costing, there are two items, fixed selling and administrative for 1 year, this one. And this one, variable selling and admin, this is unit sold times variable selling and admin per unit. Okay, this is 170,000. You have to calculate for variable selling and admin expenses. The formula is unit sold times variable selling and admin cost per unit. And total for operational expenses is 340,000. So just deduct gross profit less operational expenses. Then you got net profit 652,400. So you have done for your absorption costing under normal costing. So normal costing, that means we have to calculate predetermined overhead and we have to calculate applied overhead and you have to calculate over or under applied by comparing the actual amount. So you can find out this is the lots of formula, the longest answer, because we have to memorize all the formula individually. Okay, this one is under marginal costing. We have to calculate sales because sales not given in the question. Sales, unit sales times selling price. So the answer is still the same with absorption costing, 1,700,000. So only for this part, variable cost, the answer is different from absorption costing. So the formula, beginning inventory, this one, 2,000 represent for beginning inventory in units times product cost per unit, 32 ringgit and 80 cent represent for product cost per unit under marginal costing. We have calculated just now. Plus cost of goods manufactured, 20,000 times 30, okay, 20,000 represent for unit produced. times product cost per unit. And you get this answer 656,000. And this is the answer cost of goods available for sale 721,600 less ending inventory. Again, you have to calculate ending inventory because not given in the question. The formula is unit ending inventory. Okay, normally unit ending inventory is the missing figure. You must know how to calculate times product cost per unit. There you got the answer 164,000. And you got variable cost of goods sold. So you must know under variable cost there are two items. Number one, variable cost of goods sold plus variable selling and administrative expenses. Okay, we have to calculate variable cost of variable selling and admin. The formula is unit sold 17,000. Okay, you see unit sold here 17,000 times variable selling and admin expenses per unit. This one per unit for variable S&A per unit. So you got the answer 170,000. So you can see that every data in the statement you have to calculate individually or separately. And you got the total variable cost. So the total variable cost represent cost of goods sold plus variable selling and admin expenses. So 727,600. And you got contribution margin. Sales less variable cost, you got contribution margin. And we have to deduct the fixed cost in order to calculate net profit. So the formula for fixed cost, there are two items, fixed manufacturing overhead and fixed selling and administrative expenses. So given in the data, okay, this one is given in the data. Normally, fixed manufacturing and selling administrative, they are given in the data. So the answer is, okay, this is the total for fixed cost, 350,000. And you got net profit, 622,400. And the last step, we have to compare net profit under absorption costing and net profit under marginal costing. And we find out that the difference incurred because of fixed overhead that we have calculated under absorption costing. Okay, the formula next, net profit under absorption costing 652,400. We just take from statement of income plus fixed overhead in beginning inventory. So the formula is fixed overhead per unit. Just now we have calculated fixed overhead per unit using POR or predetermined overhead times 2,000 unit. So 2,000 unit represent beginning inventory in units. And you have to deduct or less fixed overhead in ending inventory. So this one for fixed overhead per unit times 5,000. So 5,000 represent for ending inventory in unit. And you got the answer for fixed overhead in ending inventory 50,000. Then you can find that net profit under marginal costing. So this is the way you want to check your answer for absorption costing and marginal costing. Actually, absorption net profit under absorption costing and net profit under marginal costing is the same, but in this situation it is different because of fixed overhead beginning inventory and fixed overhead in ending inventory is included under absorption costing. So we have to adjust for fixed overhead in order to get net profit under marginal costing. Okay, you can see that. Absorption costing, net profit is 652,400 and marginal costing, net profit is 622,400. The different amount is 30,000. Where you got this difference? Okay, ataupun why does it exist? Okay, the answer is absorption costing or only partial of fixed manufacturing overhead is expenses. But this one, all fixed manufacturing is expenses. You can see this one, all. This one, only part. And another one, for absorption costing depends on the unit sold, depends on the unsold unit. So for unsold units, part of fixed overhead is absorbed by the ending inventory, or in other words, fixed overhead is calculated in the product cost per unit ataupun fixed overhead is inventory. But under variable costing, no portion of fixed manufacturing overhead cost is absorbed by the ending inventory, or in other words, fixed manufacturing overhead not included in the product cost per unit. So that is the main reason why there is the difference between net profit under absorption costing and marginal costing. So nama baru marginal costing. Okay, that's all for today. Hopefully that you can compare. Okay, discard. Okay, habis. So hopefully you can understand ya for this the different ya. Saya pun tak nak ulas, you just listen, you just watch my YouTube. So I just want to see any, saya baca korang punya apa, sampai mana tadi? Muzakir, Ainin, Sofia, selamat pagi cikgu. Ya, selamat pagi. Ni siapa yang datang awal ni, saya baca lah kan. Sofian, good morning. Yes, good morning. Ni siapa? This Ling. Okay, Ling. Okay, Ling. Nurina, Assalamualaikum and good morning. Morning. Okay, Farah Nabila. Morning. Morning. Okay, this one. Zulaika, good morning. Okay, good morning. Okay, Aisyah Subar, good morning. Okay, morning is morning cikgu, morning. Ari apa benda tu? Ari okay lah, apalah. Morning cikgu Arifah, Arifah. Morning. Hasanah, selamat pagi cikgu, selamat pagi. Adisha. Hai daripada Izati. Okay, oh Izati kenapa tak dapat internet? Bagus, Izati tak dapat internet tapi datang untuk kuliah. Bagus. Morning cikgu Alia, morning. Okay, SMDD ni selamat ni. Okay, Assalamualaikum cikgu. Assalamualaikum, Waalaikumsalam. Fatihah, morning cikgu, morning. Zulaika Johan, morning. SMDD, good morning cikgu, bukan SMDD dah tadi ke? SMDD, apa ni? SMDD banyaknya SMDD. Oh cantiknya cikgu, ya ke? Alhamdulillah, makasih. Assalamualaikum Yasmin. Yasmin, ada ketapi tak hari ni? Ada ketapi ke? Apa suket? Tak ada kan? Okay, study. Okay, Hadira, morning. Okay, morning. Hadira, morning semua, morning. Ayila, morning cikgu, morning. Kina, morning. Morning. Masih baca je ya. Syahira, morning. Assalamualaikum, Waalaikumsalam. Ni pelajaran datang awal ni kena appreciate kan. Farah Nabila, good morning. Morning Husna. Morning. Husna, morning cikgu, morning. Husna sudah 2 kali dah. 2 kali. Aiman. Assalamualaikum cikgu, Waalaikumsalam. Aziz. Okay, morning cikgu, morning. Nadila, morning. Hi, morning. Adriana. Assalamualaikum cikgu. Waalaikumsalam. Okey. Morning cikgu, morning. Hai puan. Hai. Rizal. Assalamualaikum. Ya, Waalaikumsalam. Taish. Ni apa? Apa tu? Tasha. Sini kot. Assalamualaikum cikgu. Waalaikumsalam. Morning cikgu, morning. Baguslah pelajar-pelajar ni kebanyakan pelajar perempuan. Ada tak laki-laki tak ada ke? Ada kot, dia malu. Okey, Yunis, Syakira. Morning cikgu, morning Syafiq. Ada pun lelaki. Waalaikumsalam Syafiq. Alhamdulillah. Ayla, Aziz. Okey, Farah, Nabila. Okey, thank you cikgu. Terima kasih cikgu. Okey, terima kasih Muzakir, Syazlinda. Okey, terima kasih cikgu. Okey, habis semua. So, saya rasa setakat itu saja. Jadi, saya harap kamu ulang kaji. So, terima kasih semua kerana sudi mendengar. Assalamualaikum warahmatullahi wabarakatuh. Bye semua.